Thanks, Morgan. And look, it's a great question. We've had a great Q1 thus far. The S&P was up about 7%, the NASDAQ up an impressive 15%. But keep in mind, most of that was valuation driven. So we had an expansion of PE multiples. Meanwhile, earnings growth actually contracted during that period. When we started the year, S&P earnings growth looked closer to 5%. We're now hovering at about 1% positive on earnings growth. We do think that perhaps after this nice move, we're headed towards, again, a period of consolidation, maybe some volatility. There are some incremental headwinds, and I'll point quickly to three of them. One, of course, is earnings. We do think earnings can still continue to be revised lower, especially when we think about Q3 and Q4. Number two is the Fed and really the market expectations of the Fed. Keep in mind, markets are still pricing in Fed rate cuts. We think they've been pretty clear. They'll pause and then go from there. And then finally, on these the bank crisis that we just went through, we do think there is an incremental tightening of bank lending, credit tightening coming ahead of us that perhaps has yet to be priced in as well. So some headwinds that we are facing, but we don't expect markets to price in a recession twice. So we already went through a pretty severe bear market last year. We do think if we do see some volatility, it'll look more like a correction, 5, 10, maybe 15%. But those are normal. 2 to 3 corrections per year are normal. And then you set up better, or at least for a better second half.
I just want to pick up on what you just said. Are you telling that even if we were actually to go into a recession, stocks have already gone through their process of pricing that in and it will just shrug that off at this point?
So markets will likely not just shrug off a recessionary environment, particularly if it's deeper than expected, although our base case is for still not a deep or prolonged, somewhat of a mild recession. But we do think some, if not much, of that has been discounted over the past 15 months or so as we've gone through a bear market in the S&P and of course, early on in the NASDAQ. We do think, as we noted, there will be some volatility as we try to get through that and try to assess how deep or prolonged this downturn can be. But we do think, again, another bear market is for us at least not a base case and more credible scenario that we see this volatility emerge as a correction.
So if you do expect more volatility, but you don't expect that, or you expect that the worst of this bear market is over, are you buying stocks right now? And if so, when and what?
Yeah, I think for now, what we've seen recently is a more defensive tilt in markets, and rightfully so. We've seen that in equities play out with, healthcare and staples have still outperformed more recently. We've certainly seen this move into higher quality parts of growth and technology, but really free cash flow has been valued. In the bond market, we've, of course, seen a move towards shorter duration, some of these CDs and 1 or 2 year treasuries that are really yielding attractive yields compared to recent history. We do think, though, as we go through an economic bottoming, markets will start to look towards, and they usually start to look 3 to 6 months ahead of when the economy bottoms, that recovery ahead of it. And that recovery playbook does look a little bit more balanced. So, not only your defensives, but your cyclical parts of the market, not only your short duration in bonds, but some of your longer duration assets as well. And, think about areas like small caps and international that tend to be higher beta. So we do think as we are getting through this period, there will be opportunities that form for investors ahead. And for long-term investors, heading out of a bear market historically has yielded higher than average returns in the years ahead. So there could be a very interesting opportunity, we think, forming really in the months ahead.